What's up, guys? I'm Nobody Special, and I've got a special guest with us today. Back once again with us is Bob Coleman, the CEO of Idaho Armored Vaults. And you guys may remember Bob has been on the channel a couple times. We had him on a few months ago because he made a fantastic call back in February where he nailed the bottom in gold and silver, and he predicted a big rally was about to happen, and it happened exactly the way Bob said it would. And now, just a couple of days ago, Bob started making very similar predictions. And Bob, I reached out to you on Thursday and I said, hey, you've had a couple of banger tweets lately. Want to come on the channel and talk about this? And then Monday morning, I woke up and silver was ripping higher. And I remember I was so upset because we hadn't had this interview done yet. And I wanted to get this out before the silver rally that you predicted happened. But as it happened, that silver rally it looks like it's underway now as we speak. So I wanted to bring you on the channel and kind of reproduce your thought process. Have you take us through what you were thinking and everything that you saw that made you make that call, because it looks like this is the second time this year that you have nailed a rally in silver. So Bob, thank you for joining us today. And you're not just the CEO of Idaho Armored Vaults. Your resume is much more impressive than that. So maybe you could take us through some of the other business models you do. I know there's regulatory issues, and guys, this isn't a paid interview or anything like that. Bob and I don't have any official business relationship. He's just really good at gold and silver, and I wanted him to talk to you about that. So tell us a little more about your many businesses, Bob.
Sure. Yeah, and it's a pleasure to be on again. I've been in the financial business since 1992. Kind of came up through the ranks of Dean Witter, Morgan Stanley back in the 90s, opened my own investment advisory practice. 2001 started a hedge fund, and then sort of by 2006, with everything melting up, I was like, this is insane. I got to start looking for something held, assets outside the system. So physical gold and silver made a lot of sense. And then I started looking at the idea of where do I put the stuff. So then every basically depository out there was either owned by a gold dealer, financial institution, or a cash in transit company, and they all had transactional based models. I didn't want that, so I started my own depository, which is basically the only independent depository I think in the country that's not associated with transactional type business to stay alive. The depository basically is a standalone facility. My investment advisory practice, I have a subsidiary that buys and sells metals. So I don't need to necessarily hold inventory per se. I can actually just go to the wholesalers and buy inventory when I need to on demand. And that's one portion of the business. I also run a hedge fund that's actually invested in physical metals for full disclosure. So people realize it's a non-leveraged fund. It's about 75 or 74% invested in silver, about 25% roughly in gold. Roughly speaking, and it's all physical metal held outside the financial system. So I get involved with that, and then we also have some other businesses in terms of tactical gear. We sell thermal imaging, night vision, level 4 body armor, all that good stuff, because that's what we use here at the facility. So we're like, well, why not become a dealer for it? So
you have the best
number of different things
there. I've seen some of them. Yep.
Yeah, and then we also run armored trucks as well. So if we need to move the metals, we can do that. Plus, I also get involved with insured couriers, and we have insurance policies through Lloyd's of London for shipping, transit, armored car, that type of stuff, as well as here at the facility. We run currently right now we have an $800 million policy here at the facility.
I want to get onto this call that you made because. And again, folks, not a sponsored interview or anything like that. I want to be. And it's one of the things I like about you, Bob, and having you on there is you're more of a technical guy. You're not a salesman or anything. By the way, you got Bob's Twitter is up here right now. Must follow for any precious metals investor. In my opinion, it's at Profits Plus ID on Twitter. Be careful. There are some impersonators out there, as there's known to be. Twitter is a haven for bots these days. But I want to show this chart here because we're looking right now at hourly candles on the silver chart. And right here, I've zeroed in on December 2nd at roughly 12:30 p.m. Eastern time is when you started kind of making these calls that a rally was coming in silver. And this was eerily reminiscent of that call that you made in February. That was a very good one. And over the next few days, you made several tweets to this effect. And it was somewhere around here on Thursday that I reached out to you because I was reading these posts. And I'm saying, hey, it looks like Bob has made another really good call here. We set up this interview. And then, of course, Monday morning, silver just ripped higher. And here we are, 32 and change. Looks like setting up to go higher. So one of the things, Bob, you've forgotten more than I could ever know about the precious metals industry, but it's really hard to understand you sometimes. Don't take this the wrong way. There's a compliment in here, I swear. You swim in this stuff all day. And so, a lot of things that are second nature to you, the average person doesn't understand. So my goal here is to recreate your thought process over December 2nd to December 5th and how you arrived at this call that looks like a really good call and why silver was going to rip higher. So let's start with this first tweet. In my opinion, that was like your first tweet setting up this run. You said silver set up on an 8-hour chart. This is December 2nd, around 12:30, around lunchtime. Silver set up on the 8-hour chart, rising relative strength, a double bottom, inverse head and shoulders, and sentiment is horrible equals possible rally coming. This was a very, very contrarian call here. And then in this same post, you posted this chart here. So we've got a lot going on in this chart. Now, using small words so that the rest of us can understand what we're looking at here. Could you elaborate a little bit on some of those things, like the rising relative strength, the double bottom, what some of these terms meant in your tweet, and why that gave you the idea that a bottom was approaching?
Yeah, it's interesting because I posted this to some other technical people, and they're like, "Oh, we're short-term bearish, but long-term bullish." You look at Twitter is good for a number of things, and what I try to do is I'm not trying to sell people. I'm trying to educate because we're all at the end of the day, we're all in the same boat together. We're trying to figure out, where to protect ourselves, how these metals are going to perform, and my job isn't to try and sell people to buy more inventory. Of course, I'm in that business, but I kind of use Twitter as a way to help educate people. So I try to explain things as best I can, because I always look at myself as an idea of whatever I say, you kind of have to be able to explain it to a jury of your peers in a way. So I try to use a lot of analytical type of language to try and help people understand. And like you said, sometimes it just goes right over, the head, I guess, for a lot of people. But basically, if you go back to that chart, that at the bottom you have that sort of upward line. That's relative strength. And so what you're trying to see with relative strength is when prices are making lower lows. And relative strength starts to make higher lows. That's what they call a positive divergence. And so you watch for these types of moves. It's not obviously a guarantee, but it's a tool. And it helps you recognize when you start to see things starting to develop. It's you use other types of technical factors or fundamentals as well. People like to watch fundamentals as well. But that these are all little keys that I kind of watch for. And I've been doing this for a long time. So it's, please, if you're just getting into this business or only a couple years into investing, I've been doing this for, plus 30 years. So it's, you're just looking for repetition, these types of fractals, these repeating patterns, things like that, just to try to help give you some guidance. And of course, there's a lot of sort of things you learn along the way in terms of, market action happens, around holiday time or whatever it may be. There's, some of those types of things. But going back to the chart, you have two arrows showing a double bottom that was forming there, and then you have the inverted head and shoulders, which tends to be a very bullish factor when it starts to develop. Basically, you look for that right shoulder. When that right shoulder develops and you have this rising relative strength, meaning that the price action isn't necessarily and the relative strength is showing you that we may be sort of, the sellers may be flushed out, is what you're trying to look for. And so
an inverse head and shoulder, if I could pause you for a second, a head and shoulder pattern, basically the opposite of this one, is usually a reversal pattern indicating a top is in an inverse head and shoulder where the head dips below the two shoulders. That is typically a sign of a bottom, as well as this double bottom pattern that you're pointing out, how the lows kind of stalled out at the same level, also an indicator of a bottom. So you're pointing out two different technical patterns indicating a bottom in price here. Not a perfect technical, pattern, but you're right to point those out. And at the same time, the positive divergence where you have an RSI heading higher, even as price is heading lower, all indicators that the price of silver was about to reverse direction. Am I over summarizing that? Okay.
Yeah. And again, because we live in a world of computers and algorithms and that type of thing, what makes this more difficult, I think, in today's world for a lot of traders is, these algorithms are set to different time factors, or you may have, the 3-hour chart, maybe a lot of these guys are keying off of a 3-hour chart or a 4-hour chart or a 6-hour chart. So you don't know really what a lot of these bigger programs or these fund managers or high frequency trading, what they're keying off of, but you're just trying to search and try to look for, where would be the best lineup. So, like, for example, if you're going to Las Vegas and you're playing blackjack, and you're counting the cards, and that there's some high cards coming, that's your best probability to kind of hit a home run or make some money. Well, it's the same thing in investing in a way, or trading, is you're looking for that setup that gives you, maybe the best opportunity or probability. So that's what I try to look for. I'm not trying to be like, this, guy who runs a subscription service, and, I always say one thing one day and one thing the next. I try to just say, listen, this is what I'm seeing, and trying to give people sort of at least, something to look for.
Now, is there any reason you chose 8-hour candles for this chart? I've seen dailies, I've seen hourlies. 8 hours, not something I usually see called out.
Well, again, what I kind of realized here was the trading patterns that we follow, or that you watch for in the markets. The 8-hour kind of showed the cleanest pattern, if that makes sense. So you have like that shaded portion in the chart. That's what Bollinger Band. So you have an upper Bollinger Band, lower Bollinger Band, and so you can kind of see that middle line is sort of the, when it crosses above it, it's strong. Crosses below it, it's weak. And so it seemed like it was following a little bit more of a cleaner pattern than, say, a 1-hour chart or 2-hour chart. So,
okay, so when you're looking for this and you're making a call like this, you don't automatically go to 8 hours. You check the 1 hours. You're checking the dailies, the weeklies.
Yeah, you're looking at a lot of different stuff, because as anyone that trades in technical analysis, a lot of these guys, which are very good on Twitter, and have subscription services and so forth, they use a myriad of different things when they look at chart patterns. Nothing replicates itself over and over again. You're always looking for patterns, but you're also at the same time trying to use different technical, technical work to try to find where maybe that probability kind of lies, or opportunity lies.
Okay, so that gives us some pretty good insight into where your head was at on December 2nd. Now, you followed this up on December 3rd, a day later, about just before 2 p.m. Eastern time. You post this SLV alert. SLV is referring to the iShares Silver Trust. Is it an ETF or a trust? There's a subtle difference, but basically the big silver ETF. You say a 42% increase in SLV shares short during the first 2 weeks of November around the election. Short interest went from 22 million shares to 31.2 million shares on November 15th. So big spike in shorts. So the market was majorly bearish silver. And then you say last time we saw 30 million plus shares short was March of this year, right near the beginning of a major rally. Now I'm going to show you, this is the screenshot of the image that you showed there. I want people to be able to see, what you were talking about here. So you can kind of see here, you have the numbers highlighted. Here was the number of shares sold short on Halloween, 22 million. And then 2 weeks later, we're at 31.2 million. So, the bears were really piling on the shorts here. And then just kind of scrolling down, you talk about how the last time we saw anything like this was March 28th. And of course, we had a rip your face off rally in silver in February and March. So you're drawing parallels to that prior event where you made a very good call. Now, you followed that up just a couple of minutes later with this tweet. As you can see, SLV short sale volume has nosedived the last 2 weeks. So now we're not talking about total shares short. Now we're talking about volume, the amount of trading activity in SLV shorts, back to levels where the rally began in February. And then you show this chart, which the blue line, I believe, is showing the volume of SLV shares. And you point out how, hey, check it out in February.
Yeah, that's short sale volume. So
Yep.
so a lot of that can also be market maker activity as well. So when you see these big price, or I guess that swell or spike in short sale volume, that could be market maker activity, shorting shares instead of maybe delivering metal to the ETF and creating shares and selling those shares into the market. They may actually take in order flow and short against that order flow, in order to make a market. So depending on their activity. But again, what you're trying to do is hopefully, and you're doing a great job of trying to break this down, is just look at very simplistic issues and try to say, listen, we're all, at the end of the day, we're kind of like a sleuth, I guess, trying to figure out the clues to where this thing is going to head. And again, you're trying to line up the stars here, I guess you could say. And so not every time it's going to look like this. It may look like something completely different the next time. I mean, back in February, you had some fundamental issues that were different than whereas today, where in February this year, you had the managed money crowd heavily short silver. And you don't have that today. You actually have managed money actually long, but they've been actually curtailing those long positions, over the last, few weeks. So, you've been seeing that selling. You've been seeing the open interest take nosedives. So all these types of things are it. The market is living and breathing. You're just trying to kind of gauge, at that moment what it looks like.
So, right, no one of these data points is a reliable tell, right? Because if it was, everybody would trade on it. And then if everybody's trading on it, somebody would write an algorithm to take the other side of the trade or to front run it, and it would no longer work anymore. So you're just you're doing your best to read the tea leaves here. And nothing is ironclad, but this is now a lot of data points, right? You had those multiple bottom signals with the inverse head and shoulders in the prior charts. You had that double bottom pattern. You had that positive RSI divergence, all technical indicators of a bottom. And now we're seeing a big spike in short volume, which means you've got a lopsided position in the market. A lot of people betting silver is going to go down. Is it irresponsible to use the word squeeze here? Are we setting up for a squeeze with short volume so high?
No, I think there's right now, and we can get into this sort of, we'll get into this a little further, but this is what's actually transpiring at this point is a form of a squeeze that's actually starting to develop.
Okay. And then while you've got so many people are short, at the same time, the decline in volume, right? You've got a lot of people are on this side of the trade, but now all of a sudden there's a lot fewer people joining them, right? Which is what the decline in volume would suggest. So that this chart, correct me if I'm wrong, this shows the bears are running out of gas, that they're kind of exhausted here, right?
It's an old saying on Wall Street, you never short a dull market. And the reason why you don't short a dull market is because everybody who's sold is sold, and volatility starts to collapse and everything just kind of goes sideways. And then all of a sudden, it's like I made a comment today on Twitter. Someone was saying, well, God, if you just lend your shares and the shorts come in and use those shares and borrow against that and short the thing down, isn't that going to hurt the price? And one of the rules on Wall Street, I kind of call it laws of the jungle, is if they know that the strength is in the market, they'll be more than happy to lend those shares out to the sucker who's going to borrow them and to short them into the market, because they know that they're going to get fleeced at some point and they're going to be the fuel for the fire to take the price up even more. That's unfortunate to say that, but that's just how sort of Wall Street works.
All right. So we're setting up for a pretty contrarian call here, Bob. And again, this is on December 4th that we're at here now with this. So where are we? We're right around here in the chart. All right. So we're a little higher than when you first made the call, but it's not exactly a rip your face off rally here. And I think it was at this point that I reached out to you to set up the interview, because I kind of saw that similar setup to the call you made in February. And then there's one more tweet I want to talk about here, because this one, now we're getting into the weeds of some of the the more complexities of that are unique to the precious metal market. So I want you to do your best to talk for us, crayon eating, smooth brain folks over here. You say we have a blowout in the EFP, exchange for physical premium. This is on December 4th. All right. And you're saying in silver, this appears to be someone caught short or bidding up the March silver contract against the spot market. Have not seen this type of blowout since 2020. Would you be so kind as to put this into English for the rest of us?
Yeah, if you could go back to that chart just for a second. No, not those. It was that hourly or okay. Basically, but where it says Bob, yeah, I think it was that spike on price.
This one here.
Yeah. I think that's when I put that out. The EFP basically is what they call an exchange for physical premium. It's a spread trade. It's not necessarily, a lot of gold dealers get this completely wrong. A lot of promoters get this wrong. They think it's a trade that says, listen, I'm going to take my futures contract and I'm going to convert it into physical or vice versa. It's really a spread trade. It takes the London, in simplicity, it takes the London spot price, the physical market price, and it nets that against whatever the lead month futures contract is, or whatever futures price you want to use. So for example, right now we're in the March silver contract. So a lot of times you'll take the silver spot price that the physical metal trades for, and then you compare it against what the March futures contract is actually trading at. And that difference in price, for simplicity purposes, is the EFP in a way. But the EFP is technically, it's like an OTC product. It's basically the banks make a market for that spread. So it's really the big boys. When you're watching that spread, that's the JP Morgans, HSBCs, a lot of the big boys that are the bullion banks are the ones that actually are making that market.
Okay, so I heard a lot of collective huhs coming from people in the future here when you made that explanation, including one from me. So help me out a little bit more. So in exchange for physical, it's a little bit of a deceptive name. Then you're not trading your COMEX warrant for a physical bar. That is not happening here.
No, you're right.
I'm taking my contract. Say I've got a contract for March delivery at $31, and the spot price is $31.05, and I do an EFP. What happens?
You're capturing basically a nickel per ounce in that. So for example, I'll kind of walk through this process. About 2 weeks ago, when you made the roll, for example, from the December contract, it's now in delivery month, so it's expiring at the end of December. What people do is they then sell the March contract. They buy back the December and they sell the March contract. So what is where it gets really maybe confusing, but I'll walk you through the process. A lot of gold dealers will say, listen, that is manipulation, because they're just shorting the contract down to kill the price. But what's actually happening is, when you go out in time, out to March, there's a time value of money. So the price of the spot price of the metal today is going to be, say, $31 an ounce, but in March it may be 45 cents higher, because there's a factor of time value of money, higher interest rates, and so forth. There's a cost to store the metals and so forth. So that futures price of an ounce of silver is naturally going to be a little bit higher to account for that time value. So about a week and a half ago, 2 weeks ago, that spread between March silver and today's spot price was about 45 cents an ounce. So on average, if you wanted to short the March contract, let's say you had 1 million ounces of silver, you wanted to go ahead and sell futures contracts against that silver. If you do that on an annualized basis, that would have been about a 5 to 6% return, by just constantly rolling the contracts. And people in the industry do that. It's a very common practice. And this is where I think people say, well, that's the banker cartels that are shorting the price down. No, it's just the industry and how the industry operates, because gold and silver at the end of the day are money. And it's one way to capture a return.
Okay, so
So
you're
now,
talking about a blowout in the EFP premium here. Or
yeah, I'm going to
that
walk you
EFP
through this.
premium, is that the fee to do one of these EFP transfers?
No, no. That's the spread. That's
Okay.
basically saying, 2 weeks ago, the March contract was 45. The contract, let's say, was 45 cents, plus 45 cents. Meaning, if you were going to sell a March contract against maybe your physical holdings, you would garner 45 cents an ounce in profit. In a perfect world. So roll forward to last week, and all of a sudden, um, that and in natural and this is an important thing to understand. That EFP, the exchange for physical premium, will naturally decay to zero by the time you get to the expiration of whatever futures contract you're using as your trade. Um, and so what's happening is these banks are net short the EFP. They're a market maker, and because ultimately that EFP is going to decline to zero. And so what happened in March of 2020 was something very, very unique that happened when all of a sudden the EFP, you had the big sell-off in the markets, and COVID came. It blew out all the longs, and all of a sudden the shorts and you had where all of a sudden the shorts that were short the futures as a hedge against their physical position in London, all of a sudden couldn't get to that physical position because everything was closed. The logistics was closed and so forth. So now all of a sudden they had to go back and cover their short position because they couldn't access their physical metal. And all of a sudden that big rush of buyers that came into the market to buy back those short positions, well, the longs were already blown out of the market, so it was a very one-sided move, and you had the EFP blow out with gold. Gold went to a $76, I think, premium, where typically it was around maybe uh, $15 or $20 or something like that, and you had some huge losses by the banks when that occurred. Going back to last week, the EFP was kind of floating along. We started off at about, right when December contract rolled, we were about 48 cents, and then it dropped about a penny a day or something like that. Well, last week it went from about 45 cents to about 65 cents overnight, and that's a big jump. From a percentage standpoint, that's huge. You don't normally see that kind of move. Sometimes you'll see maybe 2 cents move or something like that. But when you see basically a 50% move in that spread, there's stress in the system, if that makes sense.
So
When you
you
see
saw,
these,
so you see a blowout in the EFP premium. You're seeing the front month futures contract rise rapidly, but you're
the
not
lead
seeing the
month.
spot price rise with it.
Right.
Right.
Well, you see the
Or as
prices
much.
are yeah, the prices are moving, but the lead month futures contract is accelerating faster than the spot price. So for example, if silver was up 20 cents that day, the futures market may have been up 45 cents that day. So it jumped 20 cents or 25 cents extra, or accelerated. And then it kind of pulled back a little bit, the next day, and I'm not sure of this is,
So I'm
yeah,
kind of picturing a rubber band here. Like as you
yeah,
see the premium blow out, right? You've got tension and the two prices are exerting a force on each other. They could, both could move together or one could move while the other doesn't, right? You sooner or later you're going to get that tension relieved somehow, either in the form of the futures price coming down or the spot price rising. Is that correct?
yeah. It's typically, and when you say there's fundamentals behind it. So for example, when that premium blows out like it did last week, you typically, if you have spot metal, for example, the price of the metal, it may be worthwhile to take advantage of that higher exchange for physical premium and deliver metal and then sell against that, capture that higher premium at that moment because it's artificially a little bit too high. But we can go into all these weeds that could kind of foster from this. But basically, to kind of keep this a little bit more on track. So basically, you had a spike in the EFP, which hadn't been seen really for a few years, and then it kind of came back down to about 48 cents, 50 cents, and then it spiked again. It bounced again back up, back into the 60 cent range, And then that was at the end of the week. And then you had something crazy happen, where this week you're seeing the EFP jumping to 70 cents. It's not going down at all. In fact, it's going even higher. It's making a higher high than last week, which is very unusual because the time value of money and the decay of that typically would say, okay, well, that's not going to stay for very long, because it's getting, as each week goes by, you're getting closer and closer to expiration of the contract, so you should have a natural decay. But that's not what's happening. It's actually rising, and today I think it hit it as high as in the 75-cent range. It even went higher.
The space shuttle that you made earlier?
What's that?
Was that the post with the space shuttle that you made earlier? Yeah. Oh, let me bring that up on the screen, because I didn't have that one prepared, but I definitely should have. Let's go back to your page here. Where was this one? You just posted this. Okay, here we go. You say gold and silver alert, EFP premium accelerating higher. Okay, this is today now. New high for this move. This is starting to affect gold. So now you got silver exerting price on gold. Its EFP is starting to increase. This is putting upward pressure on gold and silver prices. Banks and investment firms who are naturally short the EFP premium are seeing a lot of pain here. And then, of course, there's the rocket taking off, something reminiscent of the silver squeeze. I pay attention when I see you using language like this or imagery like this, Bob, because historically you've been quite a critic of people who do this. So I don't think you throw this around lightly. You really see something here, don't you?
Yeah, I do. I mean, this is, and it's not that I'm trying to use the rocket to try and sell metal. That's not the object here. The issue is there's stress in the system, and something is starting to unfold here that isn't normal. So, for example, there could be tightness developing in the physical bar market. There could be somebody short the futures that can't get out of that market. For example, they're trying to, you got to remember, when people rolled the contract to March, they sold, against whether it be physical positions in London or or metal that they hold to the COMEX, but they use the futures market as a hedging vehicle. That's primarily what the futures market is for, and that's why it unfortunately a lot of physical investors, they assimilate the COMEX as a fraud or as the cartel, because unfortunately the COMEX is designed to be a seller's market. It's just the way it's just the way it is. And whereas a physical market is designed to be something that's more designed for supply and demand, and if you're wanting the physical product, that's where you go to get it. So the New York market is really the kingpin when it comes to the futures markets. It's sort of our baby in a way, and that's why in the mornings when U.S. opens up in the morning, you see a lot of selling that happens. A lot of that tends to be people over in London or Europe, whatever it may be. They may be locking in physical prices over there, but using the futures market as their price neutral hedge. So they are holding physical, but they just don't want the volatility of price to collapse their profit margin. If they're a fabricator and making a product, or if they're a mine pulling metal out of the ground, they want to lock in profits or some type of price.
So the last sentence, I couldn't help but zero in on that. Banks and investment firms who are naturally short the EFP premium, like you talked about, they're constantly capturing that time decay in the form of profits by selling the front month futures contract against their physical holdings. So they're collecting that time decay. But when we see the price, or when we see the EFP premium blowing out, that time decay is moving in the opposite direction. They're taking losses now. Yeah. And so banks potentially driven to exit that short position, potentially a catalyst for sharply higher prices. Am I right here?
Yeah, if they can't come up, for example, if they're short contracts, there's two ways to unload out of that short. Basically, either come up with metal and deliver the metal against your short position, or you have to buy back that short. If the market's moving against you. Now, if you're very well capitalized, you could say, hey, listen, I can withstand this. It's no problem. But when you're dealing with a spread trade, it's a very leveraged trade. You're not necessarily dealing with, hey, listen, I parked 100 grand at my clearing firm, my COMEX clearing firm, and I'm going to, maybe margin 50% of that, and I'm going to short the market or whatever it may be, or go long the market. The market moves against you. You may have some cushion. Here, you're dealing with leveraged money. The bank. You have to remember the banks and the trading desks and so forth are very leveraged players to begin with, and that's why they use a lot of hedging strategies to try to neutralize that risk. Not only that, we didn't even scrape the tariff issue. Basically, with Trump's, talking about tariffs, what happens is, and he did this in his first presidency, where he put tariffs on China, and this is an interesting scenario that unfolded when you placed tariffs on China. Basically, if you were delivering COMEX gold or silver into the United States, and we're going to park it in the COMEX. Let's say you were short a bunch of contracts, whether it's gold or silver, and you were an Asian investor or trading firm or producer or fabricator, whatever it may be, and you were going to deliver, Chinese bars to the COMEX to settle a contract, for example, and those tariffs went in place. People don't understand that back then it was a 25% tariff. That 25% tariff gets added to the cost because it's based on the value of the metal that's being brought in. And it's based on the country of origin as well. So even if you had Chinese bars, but they were stored in London, or Chinese bars, Hallmark bars that were stored in Singapore, if you brought those into the country, you'd pay 25% in addition to what as a tax. So which would basically kill the cost or any type of arbitrage you would get from maybe naturally selling a futures contract, further out, and then against your spot metal. Now all of a sudden, those tariffs are creating enormous losses for you, and this actually occurred. And the funny thing was, I contacted the CME several years ago when this happened, because we actually had a client that was bringing metal into the country, and they happened to have Chinese Hallmark products. I contacted the CME, finally got to the right people. They didn't even realize that this I think at the time 6 Chinese Hallmarks that were made good delivery actually were actually susceptible to that tariff. And so it didn't make any sense if you were holding that material outside the country to bring it back into the United States. Now you talked about,
quick, Bob, correct me if I'm wrong, but since then we have added many Chinese refiners to the good delivery list, haven't we?
Yes. Yes.
So it's a bigger problem now.
Yes, and now you're talking about Trump throwing around this idea of Canada and Australia and other countries, and what he may be using that as a leverage tool to maybe get what he wants and in the deal making process. But in reality, if tariffs ever went into existence on these countries, the hallmarks or the refiners of those products would then become more expensive to bring into the country. Hence, that product wouldn't be available for delivery onto the COMEX, and the player that may be holding on to that product could be sitting on basically dynamite, because all of a sudden they may have to swap out of that product into another product or remelt it, but the problem with that is it creates a taxable event. They may have, it adds to the expense of that trade, and that's not something we've really seen before.
So this could, number one, it could wreak havoc on the COMEX, right? If they need to bring metal in from overseas, it's going to be a problem. Could this also possibly create a divergence in the value of bars based on refiners? Like, I can't sell this in the US without paying a 25% tariff, so I'm not going to pay as much for it, right?
Right. Either that, or like you said, or what happens is, the price of metals, it gets tighter in terms of available inventory, and that could start pushing price up. Or you could have these types of regional type of price differences. If you've seen a lot with like China and London pricing, where maybe one goes to a high premium compared to the other, you could see that unfold. There's a myriad of different things that could happen, and that's what I watch. I watch all this stuff because I don't have a life, but you just try to keep an eye on as much as you can, because that way, you're helping educate the public. You're helping in my case, helping to educate my client base. rather than just laying on this idea that the dollar is going to fall and the BRICS are going to take over the world and everything's going to be repriced in Bitcoin or whatever it may be. You're trying to just help guide people to the nuances that happen on an everyday basis. So they don't get frustrated with their investment position. They kind of allow themselves to kind of take in a little bit more of the storyline, because I still think gold and silver are a great asset to be in long term, but it's just not one of those. You're going to have ups and downs, and it's just understanding those ups and downs.
I think 2021 and 2020 and the meme stock rallies and the AI bubble, I think people have this expectation of just unreasonable returns these days, where if something doesn't double in price in 2 months, it's viewed as boring and a bad investment. And that's usually the time, an indicator is time to get the hell out of whatever those guys are in. So, this is, I guess what I'm saying is, when everybody is moving out on the risk curve, that's kind of a good indicator that you want to move back, back towards the trunk. Don't be out on the branch with everybody else, right? It's safer there. And you're showing a lot of indicators here. You've got a lot of negative sentiment that you just went over. You've got some technical indicators of a bottom. You've got this blowout in the EFP suggesting maybe some big players with deep pockets are getting into trouble. Continuing this week, now starting to affect gold. And then, you have this thing on the horizon with the tariffs that could potentially cause a lot of troubles. At a time when sentiment around precious metals is very negative, this is a really good setup, isn't it? It's just a really good setup for metal.
I mean that's the way I look at it. I mean, it's nothing's a guarantee in life. You're just trying to look at, hey, listen, this is how the deck's being dealt, and if it develops, at least I'm trying to understand how it's developing so I can kind of tell a story. And hopefully the people that follow me on Twitter, that's what I'm really about. It's trying to help educate everyone, not become, in terms of, I hate to use, fear mongering, those kind of terminologies, but I don't think people really get as much out of, I think, the social media side when you start to just follow and you get bias confirmation and everybody's looking, high-fiving when things are up, and they're just down in the dumps when things are down. It's helping people understand these moves. I think it'll empower us as precious metal investors to understand, hey, maybe the market is stronger than we think it is. Don't be so down on yourself. The nice thing about physical markets or physical metal is it's time in the market, not timing the market a lot of times. So, especially a lot of people that's been through the ringer for 20 years, they see these ups and downs. But I think, that's what I try to help.
Well, Bob, I think you definitely helped today. And again, when I see a guy like you talking like this, I pay close attention, because you're not a broken record that just is endlessly bullish metals, right? You don't throw around a lot of the popular talking points. You get down into the weeds. You confuse people, self included sometimes. But also, during the squeeze, I remember you in 2021, you took a lot of shit for it because you were a voice of reason amid euphoria. And I'll admit, I was part of that euphoria. That was kind of like when I got started with social media, and you were a voice of reason, and you took a lot of heat for it. You were willing to take that heat, and I think you deserve more credit for that than you get these days. And then that great call you had in February, and now it looks like setting up for another one. So I want to thank you again for taking the time to share that wisdom with my viewers today. Once again, guys, that's Bob Coleman from @Profits Plus ID on Twitter, CEO of Idaho Armored Vaults, as well as that extensive resume that you heard earlier today. Bob, last word before we go?
Yeah, you can also go to our website, goldsilvervault.com. We have a media page where we post articles, and we'll have this interview posted up there when it comes out. But yeah, it's, again, at the end of the day, you're just trying to learn about these markets. Try not to get too much into sort of the promoter type of I guess the influence, you could say, because it does cloud the idea that banks are going to fail tomorrow or the dollar's going to crash, maybe one day that'll happen. But right now, it's just trying to take one step at a time and trying to understand, okay, if we do see some type of squeeze, this is how it could unfold, and trying to explain how it could unfold, I think will help everybody.
Outstanding. Once again, guys, that's Bob Coleman from Idaho Armored Vaults. Thanks again, Bob, and everybody. Until next time, live small and dream big.